Hey guys, in this video, you are going to learn the best trading strategy using a stochastic indicator that can help you capture long-term gains in the market. But before we start, please click the like button, subscribe, and turn on the notification bell to get notified whenever we upload a new video. Now let's get right into the video. Let's first explain the stochastic indicator. So the stochastic indicator is a short-term momentum indicator that replicates the RSI indicator because it also compares the current candle close to the highest and lowest closes during a specific time period. For example, if we chose a 20-period stochastic, it will display where the current candle is in relation to the range of the previous 20 candles. Here on the stochastic indicator, we have two lines. The blue line, which is the %K line, represents the stochastic line and displays the stochastic's actual value, and the orange line, which also represents the %D line, is just the blue line's 3-period moving average. Some traders sometimes choose to utilize the crossover of these lines to choose when to enter and exit their trade. Similar to the RSI, the stochastic indicator is used to identify overbought and oversold zones. Traders have also marked this zone in the middle of the indicator from the 80 level to 20 level where the price swings. When the stochastic goes above the 80 level, it is regarded as an overbought area, and we expect the price to make a short-term down move. Likewise, when the stochastic goes below the 20, it is regarded as an oversold area, and we expect an up move. Therefore, a great trading strategy would be to sell when the stochastic turns overbought and buy when it turns oversold. But in practice, prices do not always follow the overbought and oversold conditions. For example, a strong uptrend may cause the stochastic to remain overbought for extended periods without any downward movement, and a strong downtrend may cause it to remain oversold for an extended period of time without an upward movement. To avoid a false signal from this indicator, you have to trade in the direction of the main trend. So when the price is in an uptrend, you will only be looking for buying opportunities, and these buying opportunities will occur when the stochastic is below 20 and about to cross back up. In an uptrend, we will avoid the overbought signals at all times. Similarly, in a downtrend, we will look for selling opportunities when the stochastic goes overbought above 80 and about to cross back down. We will ignore oversold signals at all times in a downtrend. This is the basics of the strategy. Now let's move on to the exact entry and exit strategy. This strategy mainly focuses on identifying short-term pullbacks in an existing trend and entering at the end of a pullback. We first need to identify the existing trend, and to identify the trend, we will use two moving averages. As you should know by now, a moving average is a simple indicator that helps us in identifying the trend of the market. On this chart, this yellow line is the 100-period exponential moving average, and the white line is the 50-period EMA. When the price is in an uptrend, we see that the 50 EMA is above the 100 EMA, and both the moving averages are sloped upwards. And here in a downtrend, we also see that the 50 EMA is below the 100 EMA, and the EMA are sloped downwards. Sometimes moving averages act as dynamic levels of support and resistance in trending markets, which I talked about in my support and resistance video. For example, on the left, the price is in an uptrend, and we see that the area between the 50 and 100 EMA acted as support multiple times. On the right, the price is in a downtrend, and we also see that the area between 50 and 100 EMA acted as the resistance multiple times. So in this video, we will use moving averages as key levels in combination with the stochastic to enter and exit our trades. Here on the chart, the price is in an uptrend. We want the 50 EMA to be above the 100 EMA, and we want both the EMA to be sloped upwards, and we will wait for the price to pull back to the area between 50 EMA and 100 EMA. You can also see that the stochastic is oversold, and oversold reading in an existing uptrend confirms that the pullback may be over and the price might continue in the upside direction. So after confirmation from EMA and the stochastic that the pullback is over and the price is ready to move upwards, we need a signal to enter and exit the trade. So we will use the crossovers between the orange line and the blue line. Remember that when the blue line crosses above the orange line, it is a buy signal, which is a bullish crossover, and when the blue line crosses below the orange line, it is a sell signal, which is also a bearish crossover. Traders use these crossovers to generate buy and sell signals. If the bullish crossover occurs in the oversold region, then it is a powerful signal that the buyers have momentum and the price may reverse and move upwards. For example, here the price found support 2 times on the retracement zone and the price is oversold on Stochastic. Then you look for a bullish crossover, which you get when this blue line crossed above the orange line. Then we will enter long at the close of this candle. We will set our stop loss at the 100 EMA, and we will keep a profit target at the risk-reward ratio of 2 to 9, or you extend it according to your profit target. Here is another example. On this chart, we can see that the price is trading above the 50 and 100 EMA. The 50 EMA is also above the 100 EMA. Both of the moving averages are also sloped upwards, giving you a clear uptrend. In an uptrend, we always look for buying opportunities, and to buy, we will wait for the price to pull back to the area between the moving averages and the stochastic to be oversold. So that we can expect the price to move upwards, you can also see that the blue line crosses above the orange line, which is a bullish crossover and also a perfect trigger for our entry. So we will place a buy order above the high of this candle, and we will keep our stop loss below the low of this candle. You will set your targets according to your risk to reward ratio. As you can see, the price went on to create a series of green candles, making this a profitable trade. Here is another example. You can see that the price is trading below the moving averages, the 50 EMA is also below the 100 period EMA, and both the EMA are also sloped downwards, giving you a clear downtrend. In a downtrend, we are looking for selling opportunities. We can see that the price pulled back to the space between the 2 moving averages, forming the resistance, and the stochastic is also currently overbought. Then we will wait for this blue line to cross below the orange line, which is a bearish crossover, and then we will place a sell order below the low of this candle. You can set your stop loss above the high of the candle, and you can place your targets according to your risk to reward ratio. You can see that this is also a profitable trade. So this strategy works both in an uptrend and downtrend, and with any time frame. Please click the like button, subscribe, and turn on the notification bell to get notified whenever we upload a new video. Thanks for watching.